Hello, hope you are doing well. The topic for today's market video is everything is a trade. So put on your thinking caps and let's get started with the show. Today, the naive belief in passive buy and hold investing is not merely outdated. It is a perilous strategy designed to systematically erode your hard-earned capital. In this hyper-accelerated, manipulated financial landscape, you are not merely encouraged, but compelled to actively time the market to understand precisely when to enter and exit specific stocks and market sectors. The notion of buying forever, a relic from a bygone era, is an archaic dogma that will, almost inevitably, cost you dearly. This stark realization regarding strategic market decision-making has historically had a profound, often brutal, impact on people's lives. Astute investors, those who grasp the underlying mechanisms of market dynamics, famously capitalized on the prevailing market euphoria by liquidating their positions before the devastating 1929 stock market crash. It's crucial to understand that, throughout financial history, every action within these markets has consistently been driven by trading dynamics, not some mythical long-term investment philosophy based solely on fundamentals. From speculative bubbles and tulip bulbs to railroad stocks, everything has, in essence, always been a trade. In the contemporary landscape of financial markets, this trading phenomenon is not just evident, it's screamingly amplified. This is particularly true given the insidious influence of flawed central bank policies, like quantitative easing and prolonged zero interest rate policies, the serial generation of market bubbles, .com, housing, subprime, and more recently, the post-COVID tech and SPAC boom. The pervasive algorithmic momentum trading strategies that now dominate volume, the volatile eruptions of meme stocks, such as GameStop or AMC, and the vast, government-subsidized markets that fundamentally distort asset valuations. If you fail to actively time this market, if you aren't a discerning trader, then you are simply a passenger, destined to be tossed by its volatile whims, and you are almost certainly destined to underperform. Certainly, a handful of blue-chip companies, those legendary titans, might have delivered exceptional returns if bought and held for 2 decades. Think of Apple or Amazon from 20 years ago. But selecting that right handful out of thousands is akin to finding a needle in a haystack, a feat few genuinely accomplish. Moreover, who can guarantee that the next 20 years will be so forgiving, especially given the unprecedented economic and geopolitical turbulence we face? The grim reality is there's no guarantee that these seemingly invincible companies will continue their stellar performance for another 2 decades. Many once dominant firms, like Kodak, Sears, Blockbuster, or even General Electric in its slow decline, once considered bedrock investments, have seen their fortunes dwindle or completely collapse. By the time the passive, long-term investor recognizes this shift, it's often far too late, their hard-earned gains having already evaporated in a brutal, irreversible drawdown. So, good luck attempting to consistently implement a buy-and-hold strategy when financial markets, propped up by artificial means, are perpetually long overdue for their next major, perhaps even systemic, correction. The undeniable truth is, you can make significantly more money by efficiently trading in and out of even these purportedly great, long-term investments, capitalizing on their cyclical movements rather than passively enduring them. For historical reference, we've weathered significant market crashes. The dot-com bust of 2000 to 2002 saw the Nasdaq plummet over 75%. The global financial crisis of 2008 to 2009 saw the S&P 500 lose over 50%. Along with these, numerous smaller, yet devastating, financial crises have dotted the landscape over the last 15 years. The only reason we haven't experienced another full-blown, systemic market collapse on the scale of 1929 or 2008 is the relentless, unprecedented intervention of central banks. Through aggressive asset purchases, quantitative easing, QE, near-zero interest rates, ZRP, and extreme liquidity injections, central banks like the Federal Reserve have essentially been protecting financial markets, creating an unnatural stability and inflating asset prices to dizzying heights, decoupled from economic fundamentals. Furthermore, the federal government has engaged in reckless, multi-trillion-dollar spending, particularly since 2008 and dramatically amplified during and after the COVID-19 pandemic. This profligate spending, while ostensibly aimed at sustaining the economy, has instead created a colossal facade of artificial growth. This is a primary driver behind our spiraling national debt, now exceeding $38 trillion and growing at an alarming rate, and the rampant inflation that has savaged essential items, from gas prices that jumped over 50% in a year, to grocery bills soaring, to medical care and housing becoming increasingly unaffordable for the average American. These artificial strategies, designed to bolster the economy and prop up financial markets, carry severe and unavoidable consequences. The litany of ineffective public policies implemented by an often incompetent government carries significant, compounding long-term costs that we, the public, will ultimately be forced to confront, and likely much sooner than most politicians care to admit. These costs manifest as runaway inflation, staggering budget deficits, ever-escalating national debt obligations, with interest payments now a significant portion of the federal budget, and the dangerous emergence of multiple asset bubbles. These bubbles span across critical sectors: housing, where prices have far outstripped wage growth, the exorbitant cost of insurance, the crippling burden of college tuition that has spawned a multi-trillion-dollar student loan crisis, and, of course, the broader financial markets themselves, where valuations seem increasingly unmoored from reality. To fully grasp the core issue, the insidious impact of systemic government incompetence on us as market participants necessitates a fundamental shift in perspective. As an investment strategy, it is no longer merely advantageous, but imperative, to adopt a disciplined trader's mindset rather than clinging to the anachronistic beliefs of a traditional, passive investor. Consider the violent fluctuations in asset prices that have characterized these tumultuous market periods. The buy-and-hold strategy forces investors to passively endure these inevitable, gut-wrenching ups and downs, clinging to the faint hope that government and central bank interventions will always, miraculously, provide salvation and rescue their portfolios. We saw this in 2008, 2011, 2018, and 2020. However, what happens when the next financial crisis proves too immense, too complex, or too multifaceted for these entities to manage effectively? What if central banks simply run out of ammunition or political will? Ultimately, the buy-and-hold approach places an almost religious faith in consistent, effective government intervention, which must always yield positive results. A dangerously optimistic, arguably delusional, premise. This passive strategy is fundamentally flawed. It's built upon erroneous assumptions, reliant on a continuous stream of improbable miracles to succeed. And, critically, the supply of such portfolio-saving miracles, of new monetary tools, lower rates, or more quantitative easing, is finite and diminishing over time. The law of diminishing returns applies even to central bank interventions, making each successive rescue less effective than the last. Instead, reflect on the advantageous asset prices that become available when the market capitulates and portfolios see a significant decline, a 30% or even 50% drawdown. A skilled, proactive trader does not simply endure these events. They consistently capitalize on these opportunities. Through techniques like short selling, tactical rebalancing, or carefully timed reentries, they can turn market turmoil into profit, or at the very least, preserve capital far more effectively than a passive investor. The specific time frame you choose as a trader can vary significantly, adapting to your style and market conditions. It may span from mere seconds in high-frequency trading to several months in swing trading, or even a year during strong bullish trends for position trading. The key is flexibility and active engagement, not rigid adherence to a single, static plan. Ultimately, it is crucial to cultivate and adopt a trader's mindset. This approach aligns your risk and reward profile far more effectively with positive expected value calculations, meticulously derived from vast historical market data and statistical probabilities, rather than emotional hope or outdated adages. For instance, one could easily compile a rather disheartening list of companies that, despite once being considered paragons of reliable long-term investment, have since lost all their market gains, suffered catastrophic declines in value, or even declared outright bankruptcy over the past decade. Think of General Electric, once a stalwart of the Dow Jones Industrial Average, which saw its stock price decline by over 80% from its peak. Or Nokia, a former mobile phone giant, whose market value evaporated as it failed to adapt. This list, if widely publicized, would undoubtedly haunt any long-term investor who failed to adapt. The historical data on this matter is not just conclusive, it is rigorously protected. That's precisely why the most successful, proprietary hedge funds in the world guard their data and strategies so ferociously. This is the churning, unforgiving ocean where the true market sharks relentlessly haunt. In other words, don't tap the glass too loudly. You'll scare away the thoughtless fish. Let the dumb money continue to be the dumb money in the market. It's excellent for business. It is imperative to understand that the outdated strategy of buy and hold is increasingly viewed as an inadequate, even dangerous, approach in contemporary financial markets. This passive approach is often considered less effective, almost a quaint relic, compared to dynamic trading strategies. It's an antiquated remnant of investment philosophies popularized during the vastly different economic and market conditions of Warren Buffett's early career, an era before widespread algorithmic trading, pervasive central bank intervention, and globalized volatility. In the realm of modern finance theory and today's financial landscape, every single transaction, from a minute-long scalp to a multi-year position, is fundamentally regarded as a trade, plain and simple. The only real debate left is not if it's a trade, but merely its time frame.